Hey guys, happy Sunday, and I just wanted to make this video real quick to kind of help anybody who's wondering how to run projections or kind of get an idea. I just want to go through a step by step and walk you through how you can run some projections for your stocks and get an anticipated value and the value you should be paying today and if a stock's a good deal or not. Now, most of the time I'm using a DCF calculator nowadays, and it does speed things up, but I'm of the understanding that if you're maybe new to the market, you don't want to invest in a software where you have a where it has a DCF calculator right off the bat, especially if you're not sure if you're going to want to do this long term or if you're just going to want to go with the route of index fund investing. So, I just kind of want to show you because most people already have Excel on their desktop, so this is something you can use that's fairly easy. It's not too complicated. And I just kind of want to walk you through the process of what I'm doing. And also, I think it's just good to know how to do it this way because sometimes with those DCF calculators, you can't go into enough detail. So it's good to know how to break it out yourself and just kind of move it into what you want it to be. Kind of it. I'll throw the card at the top, but I did a valuation on Dutch Bros a few weeks ago, and in that one, using the DCF calculator wasn't really realistic, considering the because the company was newly coming profitable, and also I wanted to break out some of the numbers on a per store basis. So with that, it made more sense to just do it on a spreadsheet in Excel. But I'm gonna run this video. I'm gonna assume you know some of the basics of Excel, but I'm also gonna kind of walk you through what formulas I'm putting in and explain the formulas. So first thing we're gonna do today is we're gonna do this just on Coca-Cola stock. Also, these numbers I'm gonna put in right now for all the growth rates and everything. I have not given these numbers two thoughts. I have not looked through the annual report of this company. I have not looked through anything. So do not use the numbers that this right here is going to spit out in a second to say, okay, I need to go buy the stock or not buy the stock. You need to understand, and then that's how you get your growth rates. Just plugging in growth rates from analyst expectations is not going to work. You need to have your own thesis on the company already. And I'm just letting you know right now, I don't have it. This is purely for example purposes. So don't take anything that spits out right here for valuation wise by the end of this video. Do not take that into account and let that value if you're going to run out and just buy the stock or not. Please don't do that. Okay, so first thing you're going to do, you're going to set up the spreadsheet like this. So this, I'm going to assume everyone knows how to do this. Just literally write it out like this, and you can just follow down. This is going to be our revenue growth rate. We're going to use net income growth rate, our net income margin. We're going to do our diluted shares outstanding, our share growth rate. The earnings per share is going to be calculated. Then we're going to have a low price to earnings ratio, a high price to earnings ratio. And this is going to spit out a low and a high price. And then we're going to put the CAGR down here, which for anyone who doesn't know, that's a compounded annual growth rate. So fill out directly like this. Just type it in, fill it into the cells. I like to put these in bold for some of these so you can format it how you like. It really doesn't matter. Now, next thing we are going to do is you can either put the stock price up here. You can pull it from today's stock price, which is fine. But something else you can do is if you actually put the ticker symbol of the company, so KO, you can go to this data tab and you can go over here to stocks. Click on this. Now it's going to pull up the company, and then you can go here on this little drop down thing, and then where is it? It should have the price. There you go. And it's going to pull up 70.34, which should be the final price, which, yep, 70.34. And neat thing about this is you can just come over here, and if, say, like if we wanted to do PayPal, put in the ticker symbol, and then over here you just have to confirm it's the right one, and then it pulls in the price for that. So that's fairly helpful if you want something that just constantly keeps updating and you don't have to manually do it. But either way, it works. So that is that. Now, all the metrics right now we're going to be grabbing from Yahoo Finance. Like I said, I'm trying to keep this for anybody who's not trying to spend any money on additional software or anything. Of course, you can also grab a lot of these figures from the company's annual report. So keep that in mind. If Yahoo Finance isn't going back far enough in time and you want more historical data, go to the company's investor relations section, go to the company's annual report, and they'll have a collection of them. Additionally, you can go to the Edgar database and pull it from there. I usually just go to the investor relations tab of the company's website. I find that to be easier. Okay, so for Coca-Cola right here, first thing we're going to do is revenue. We're going to look at the trailing 12 months revenue for Coca-Cola. So what we're going to do over here is we're going to go over to Yahoo Finance. We're going to pull up Coca-Cola on here. Now, from here on the left side, if you go over to financials, you're going to be able to bring up the three key financial statements. Right now we're looking for revenue, so we're going to be on the income statement. And we're going to go with annual, and if you see this TTM, this is going to be trailing 12 months. If you want, you could just do it from the end of the year, 2024. I personally rather use the trailing 12 months as it's the most up-to-date figures. So right here we see that is in thousands, so that's $47,062,000,000. So we can just do that, and we can just bring that over here, which I've actually never tried copy pasting. Okay, cool, worked fine. Boom, we got that one. Now, for net income, let's see the net income. Same thing, we're on the income statement. We're going to come down, and we're going to go over to net income. Did I pass it up? Here we go. Net income attributable to common stockholders. 12,183,000,000. You know what? Let me just copy paste it. Same thing as the other one. So we're going to move that over here. And real quick while I'm doing this, I'm just going to go ahead and format this. That's like that. Or actually, we're going to do this. Let's do that. Alright. Sorry about that. Okay. And right here, same thing. This is just formatting. It doesn't really matter that much. I just personally prefer doing it like that. Okay. So now we have our revenue. We have our net income. Now, first thing we can do, we can already set up our net income margin. Net income is equal to, or net income margin is equal to our net income divided by our total revenue. And then this, we're going to format all of this as a percent to 2 decimal places. You don't need the decimal places. I'm just putting that. So this is saying that for every dollar the company makes, 25% of it's going down to the bottom line. So symmetric. So after you hit equal, divide the net income divided by revenue. You can just carry this formula over for all 5 years because it's going to be the same as we fill in everything. We can do that. Then next thing we're going to want to do is pull out this diluted shares outstanding. Now, for the diluted shares outstanding, also on the income statement, diluted average shares. So as we can see, diluted average shares were 4.3 billion in the prior quarter. So 4,316,000,000 in the trailing 12 months, sorry. So we're going to bring that in as well. Okay. And that's fine. And then, so we're going to take our net income right here to get our earnings per share, and we're going to divide it by the shares outstanding. Net income divided by your shares outstanding gives you your net income, $2.82. Now, for the rest of this chart, let's go through one by one. So starting with the revenue, you're going to want to pick a revenue growth rate you want to use for the company. Now, one thing you can do on Yahoo Finance is you can go over here to this analysis tab, and you can go over here, and they'll have revenue estimates, and they'll give you a revenue estimate growth rate. So like right here, 5.6%. So you can use this right here and you can just plug it in. Now typically whenever I'm doing this, I've already gone through the annual report. I've gone through any of the company's filings, and I kind of already got an idea of my head of what the growth drivers of the company are going to be. So I can kind of put together in my head, do I think this is a realistic growth rate? Do I think analysts are too bearish? Do I think they're too bullish? And I can pick a different one. Typically, when I'm also doing these valuations, I'm running on a scale because we can't be exact. So I'll run lower models where I'm saying, okay, I think they're going to grow less. This is my bearish valuation. Here's my bullish one where I think they're going to grow higher. So really, you got to use a range. But for now, we're just going to say 5.6%. And we'll say that's fine, 5.6%. And we'll just carry that over all of this. And again, I like to do 2 decimal places for the percentages. Really not that big a deal. Okay, now for the rest of this. This is just going to be formula driven. So we're going to need revenue growth of 5.6%. So how are we going to do this? We're going to say take our current revenue, then we're going to add in a parentheses, and then this is going to be our current revenue times, and then you can do 1 plus this. And if I did that correct, which I did not, sorry. Sorry, what you can do is actually this plus 1, and then multiply this by this, and that will actually give you your growth rate. I don't know what I was doing earlier. But anyways, now with this, you can just copy, paste this to everything, and it's going to carry the formula over. There we go. And if you look right here, all it's doing is taking the previous year, it's taking our growth rate plus 1, and it's multiplying it by our previous year revenue to give us the growth rate. And this is basically saying, okay, year 1, we're starting at 47 billion. We think 5 years from now, we're going to be making about 58 billion in revenue. Okay. Now net income growth rate. Finding this one can sometimes be difficult. This has to go with, do you think the company is going to be expanding margins? Do you think the company is going to have margins stay consistent or fall? Typically, with good companies, you want to see the net income expanding faster than the revenue is expanding. And the reason being for this is you want a good company to become more efficient in its operation, so it's keeping more of its income down at the bottom line. Now, as a company gets more mature, it becomes tougher and tougher to grow the net income more and raise that margin because they're already running pretty efficiently. Coca-Cola is a very mature business already, so I don't expect them to grow way faster their net income than their revenue. So I think a 6% is fine. Maybe they find some ways to get operating efficiency to be better, but I don't think they're going to have anything crazy. So right here we can go 0.06 percentage, and then we're going to use that. Now, if you notice right here, you can just copy the formula from here, paste it right here, and that can save you time because it's still taking the prior year, multiplying it times 1 plus the rate right here. And this is saying we're going to go from 12 billion to 15 billion by the end of year 5. And we can see our net income margin automatically calculated because we copy pasted it. It's formula driven. So we have our net income margin going from 25.8% to 26.2%. So that seems fairly realistic. Now, for the shares outstanding, if a company is buying back shares, we're going to look to see a negative number on the bottom as they start taking shares off the market. If a company often does huge stock compensation, you often see this with companies with a lot of fast growth in fast-paced industries, they are giving out a lot of stock compensation to attract key employees. So they're going to be issuing a lot of stock, which is going to dilute your ownership. This ties directly into EPS, so this is an important number. Now, how would you figure this out? Well, companies are usually going to let you know the board of directors are the ones who authorize a stock buyback program. So you'll look for something like that in the 10K or any of the 10Qs. They'll often mention it. Or you can look actually in the financials. Now, for Coca-Cola purpose, we're going to stay over here on Yahoo Finance. And if we go back over to the financials area, to where the shares outstanding are, we can see right here they're at 4.3 billion, like we said earlier, and back in 2021 they're at 4,340,000,000. So we can see they actually are losing or decreasing their shares outstanding, which signifies they're buying back shares. Now, if you want to go farther back and get more history, you can always just go directly to the company's 10Ks. So maybe go to the 2020 10K or the 2019 if you want to get those numbers. But for purposes of this video, I think this will be fine. So right here, we're looking at, we'll say from 2024 to 2021, we'll make it easy. So 2024, 2, 3, that is 4 years. They went from 4.3 from 434. So we're going to calculate the CAGR on this. So let's first bring in our numbers. So this is going to be 2024. And then we're going to bring in this right here, 2021. That's 4 years. Okay, let's open that up. Now, compounded annual growth rate formula. This is going to be the ending value over the beginning value raised to the 1 divided by the number of years minus 1. So I usually get this first. So 1 divided by 4, 4 years is 25%. So we're going to do this right here. So we're going to take the ending value, which is this right here. We are going to divide it by the starting value from 2021. This is how many shares they had in 2021. All of this we are going to raise to 1 divided by the number of years, which we know 4 years, so it's going to be 25%. And then we are going to subtract 1. Which, if we look, it's a very minute amount, 0.12%. 0.12%, which makes sense because that is not a ton of shares for the amount they have that have gone on the market, off the market, but they have done a little bit. So to be conservative, we can use that and say 0.1%. Negative 0.1%. There we go. Okay. We can use that. This is supposed to be negative. So we're saying this is what we're going to use to decrease shares by. Then this. Go over here. And let me just make sure I got the formula right on there. I got E13 plus 1 times that. Sorry, just checking the math on here. Cool. Okay. So this right here is just telling us how many shares are expected to be outstanding by year 5. And the reason we calculate that is because that's going to tie directly into our company's EPS. So we can see EPS is expected to grow from $2.82 all the way to $3.58 by year 5. Next, price to earnings ratio. What should you use right here? Well, we know the market typically trades between a 15 and 20 for most companies. One thing you can also look at is what the company historically trades at on a price to earnings ratio. So you can find the historical, and then you can look for what its competitors is trading at. For the sake of this video, we're going to speed it up and just use a 20 to 25. So currently Coke is trading at a 25, so I think 20 to 25 will be fine. It is a premium business model, but it is a mature company as well, so it's not expecting a lot of growth. Because of that, it's not going to command any insane valuation, but a slight premium at a 25, I could see that happening. Maybe slightly overvalued at that, but that's alright. Now, this is just going to be, so that's how we got our PE ratio. Now this low price of the stock is just going to simply be this price to earnings, and then you multiply it by the earnings per share. You do that once, you copy the formula over, it's going to do that for all of them for you, and you don't really have to do anything else. That gives you a low price. Now, as you can expect with this one, it's just going to be the high price to earnings times the earnings per share. Copy this over, and we can see the price right here. One thing I should note is this is just for the stock price. This is not taking into account the dividends that Coke is paying. So just keep that in mind, that the return is not the only thing you're getting. If the stock is paying dividends, you're getting the return from that as well. Now, for the low and high CAGR. We already went over how to calculate CAGR earlier, but let's go ahead and do it right here. Now, for the first year, this is just not applicable, or you can still use it based on their stock price, but you don't really need to. You can just do a regular percentage return, which is going to be new minus old divided by old. So for example, this one, we're going to do the new stock price of 56 is what it's saying its value should be today, minus the old stock price we brought up here of 70.34 divided by the old one. And all of these we're going to do as percent real quick while I'm doing this. So it's saying it should fall by negative 19.7%. Same thing for this one. So we're going to do the new price minus the old price over here divided by the old one, and 0.31. So basically in line with these current valuations. Also, this makes sense right here for this number because we're saying this is what the company would be valued at a price earnings of 20, and we can already see over here on the website that it's currently valued at close to 25, so it makes sense that right here the return would be negative because the stock is trading at a higher multiple than 20, as we can see right here. Now, for the low and high CAGR, typically, if I'm honest, I usually only focus on the last one, but we can do the other ones just for sake of the video. So, remember, we're going to do our ending value, which right here is going to be this one. Then we're going to divide it by our beginning value, which is going to be this one right here, which is our starting value. Now, something you can do is if you hit F4, it's going to lock that formula right there. So whenever you copy paste a formula, it's always going to keep that cell E3. So hit F4 so it puts those dollar signs. Then you're going to hit your parentheses, and we're going to raise it to the 1 divided by the number of years. So 1 divided by 2, I can do that math in my head. That is going to be 0.5 minus 1. And this is saying negative 7.72, which makes sense because the stock price is lower than what it is over there. Now, going here, you can just kind of copy paste the formula right there, and we see going like that. And then the only thing we're going to have to edit in this formula is this decimal place right here. So 1 divided by 3.33 repeating. Do 3 repeating right here. This one is going to be 1 divided by 4. We know that's 0.25. And this one is going to be 1 divided by 5, which is 0.2. Now with this one, there is a way you can run a formula if you put like the year number right here, 2, 3, 4, and run the formula. I find that honestly to be too much hassle. I rather just go in and edit the number right there. So I don't find it that big a deal, but if you want to, you can do that. Now right here, we can check the cell that's pulling, which it should still be pulling the right ones. Yes, the high price divided by the starting, raised to the 0.5 as we see right here, minus 1. And honestly, we could probably just do this, and we can just double check our formulas and make sure it's pulling the right thing for everything. So if we go here, pulling that, correct decimal, pulling that, and right here, pulling that and that. And this gives our CAGR right here, 0.34 to 4.92%. Now remember, like I said at the start of the video, do not take any of these numbers to say, oh, this is only giving you a 4.9%. This stock is not a great value. I don't know. This is just for example purposes. Like I said, I didn't put any extra thought into this company. I did not put any extra thought into their growth. If I think these growth rates are acceptable, if I think this share buyback is acceptable, that's something you have to do more work whenever you're building out these valuation models. But this is just a key fundamental idea. So when you go, you can kind of get an idea of, okay, what should I be paying for the stock? Now, for example, a CAGR, what's something you'd want to look for? It varies from person to person. I personally say if the CAGR is honestly under 11 to 12%, I don't think it's worth your time, because in an index you can get about 9-10%. So why are you going to waste your time on a stock giving you a 9-10% market return and take the extra risk of it just being a single individual company? Me personally, I always use a discount rate. 15% is my typical what I'm looking for. Sometimes if it's a little under it and I do like the business model of the company, I'll be fine with that. If it's significantly over, of course I'm okay with that as well. But usually when it's significantly over, that's when I run more valuations and more different scenarios to make sure I'm not overestimating something. But that's just something to keep in mind. The rate of return you're looking for is a very personal thing. It's something that has to go along with your risk tolerance. Some people may say, okay, 10% return or 11% return, that's good enough for me because it's a stable company, stable business model. I don't have to worry about it. And that makes perfect sense if it works for you. That's what makes sense. So I hope y'all found this video helpful, and I hope everything I was saying here kind of makes sense for anybody that hasn't run a valuation model or was unsure on how to set some of this stuff up. I know whenever I first started investing, it was rough trying to get some of this to work. So I thought it'd just be helpful to have kind of a step-by-step guide of how to set it up. Nothing too complicated. I think most people should be able to do this, but I just kind of wanted to give a good example of how to do this.